February 2018. He was nominated by President Donald Trump and confirmed by the United States Senate. Jerome Powell started his distinguished career by studying politics and law at Princeton and Georgetown universities. He moved to investment banking in 1984 and has since worked for several financial institutions. He served as an Undersecretary of the Treasury for Domestic Finance under President George A. Bush in 1992, was a visiting scholar at the Bipartisan Policy Center, and served as a member of the Federal Reserve Board of Governors since 2012. In short, we greet a man for many seasons, and hopefully for many seasons more to come. Thomas Jordan studied economics and business studies at the University of Bern, completing his doctorate in 1993. He wrote his postdoctoral thesis during a research period at Harvard University. 1998, he became a lecturer, 2003, an honorary professor at Bern University. Thomas Jordan joined the Swiss National Bank in 1997. 2002, he became head of the research unit. 2004, he was promoted director and shortly afterwards appointed as an alternate member of the governing board. 2007, he was appointed member of the governing board by the Federal Council, and 2012, he was appointed chairman of the governing board. Thomas Jordan is a member of the board of directors of the Bank for International Settlements, BIS, in Basel, of course. He's also the governor of the International Monetary Fund, IMF, for Switzerland, and holds also many other important positions. In short, another gentleman for all seasons. The format of our evening works like this. Jerome Powell and Thomas Jordan will discuss, with my modest moderation, the challenges and goals of the current state of the economy and, of course, of our financial systems and institutions. Be prepared. The two gentlemen will not solve every problem tonight. But you, ladies and gentlemen, will certainly profit from their knowledge, their insight, and their responsibility for a hopefully safely balanced world, not only for the wealth, but also for other benefits of nations. Therefore, one also could say, by referring to a famous statement of a former US president, not stupid at all, it is the economy and it matters. Thank you. Now we proceed to these tables and we start the discussion. May I please beg you to come here on stage. Excuse me.
That's not for me.
It's for you if you need more.
Yeah, he gets to keep his. Mm-hmm. That's not fair.
Okay, it's not fair. Here we go again.
Thank you. Thank you.
We don't foster advertisements. Okay. Let's start with a relaxing question. What's your relationship with Switzerland? How do you perceive our country? Do you like even love it? Do you visit it? Do you do sports, hiking, swimming here? The people are curious.
That's a lot of questions. I could take a full hour on that. No, first of all, Martin, thank you very much for your kind remarks, and thanks to everyone for your warm welcome. I really appreciate it. So Switzerland is a place where central bankers come on a regular basis to Basel, and it's a place where we meet with each other internationally. We share very candid views, and as equals, person to person, we develop close personal relationships with other central bankers around the world. So it's absolutely essential in this globalized world that we live in that we have strong multilateral relationships like that, and they really come together importantly here in Switzerland. In addition, of course, I've been to Switzerland many, many times on vacation and with my wife, and a long time ago as well. We were talking earlier, 44 years ago was my first trip to Switzerland. And we did not climb the Matterhorn, but we did visit Zermatt. But, I know it to be a beautiful, welcoming place and a friendly place and a nation with which we feel strong kinship always.
And of course, you made also contact with Thomas before.
Yes. there was that too.
Very good. You started your career as a lawyer and later moved to investment banking. What prompted you actually to join the Federal Reserve Board and become an expert in monetary theory?
So I have had a varied career. I was briefly an attorney. After that, I was an investment banker for some years, and then I became a private equity investor for a large part of my career. But I've also periodically left the private sector to do public service, and that's something that's more typical of the American system than I think of many other systems. And I think there's a great benefit to it. I think that private sector work can really inform your role as a public servant and vice versa. So I feel very fortunate to have had that. The story of how I joined the Federal Reserve Board was that I got involved in the debt ceiling confrontation of 2011, and I worked very hard to achieve a resolution. This is from the private sector. And as a consequence of that, I was appointed by then President Obama to the Federal Reserve Board, and then, of course, President Trump appointed me as chair in 2018.
Did you ever regret to make the step to the public sector?
Never. Absolutely never. No, it is a great honor to serve, and in particular to serve at the Federal Reserve, which, of course, is committed to non-political decision-making based on the best analysis that we can muster. It's a great place that has a very strong ethic and very high morale among our people, really because of that commitment to non-political public service.
And very strong impact, of course, of the...
It's very important.
Yeah,
yes.
Very important, no question about that. So let's go a little bit more into the details of our discussion of tonight. The global economy has lost momentum, and it is set to grow at a slower pace this year than in 2018. What do you think may be the cause of this slowdown, weakness? It's also a question for Thomas.
I shall start.
Please.
Okay, so with your permission, Martin, I'll start just by pointing out that the United States economy has continued to perform well and is in a good place. In fact, we're well into the 11th year of this expansion, which began back in the second half of 2009. It's now the longest such expansion since we began keeping reliable records. And the outlook, the most likely outlook for our economy remains a favorable one, with moderate growth, a strong labor market, and inflation moving back up close to our 2% goal. All that said, there are significant risks, and we've been monitoring those, including, as you mentioned, slowing global growth, uncertainty around trade policy, and also persistently low inflation. I'll just make a couple of quick comments on that. Mm-hmm. I think we grew at about 2.5% in the first half of the year. For the year, we'll be somewhere between 2 and 2.5%. That's very much driven by consumer spending, which represents 70% of our economy. Consumer has been strong. The service sector has been strong. The manufacturing, trade, and business investment side has been weaker and is, in fact, now sideways to slightly down. It's a smaller part of the economy, and by the way, that pattern of a strong consumer economy and a weaker manufacturing, investment, and trade economy is fairly common now around the world. Meanwhile, our labor market is in quite a strong position. For a year and a half, we've been at half-century lows in unemployment. We've got higher labor force participation. We've got wages moving up by so many measures. The labor market is in a good place. I think today's labor market report is very much consistent with that story. And we've got inflation moving back up to 2%. So overall, we're in a good place, and the outlook is good as well. I think part of the reason the outlook is good is that the Fed has, through the course of the year, seen fit to lower the expected path of interest rates. That has supported the economy. That's one of the reasons why the outlook is still a favorable one, despite these crosswinds that we've been facing. So you asked specifically about global growth. The global economy has been slowing since the middle of, let's say, 2018. We see that continuing with China and Germany and the EU. There are many factors that are driving that. Trade policy uncertainty is one of them, but it's not the only one. But trade policy uncertainty will be weighing on business investment decisions and that sort of thing. So still, though, I'll just wrap up by saying we see the most likely case for the U.S. and for the world, too, as continued moderate growth. And at the FOMC, we're going to, as we move forward, we're going to continue to watch all of these factors and all the geopolitical things that are happening, and we're going to continue to act as appropriate to sustain this expansion.
Thomas, do you share this perception?
Well, very much, but let me say a few words about Switzerland.
Please.
So we are a small, open economy, very open, and our biggest market is Europe, but the United States became a much bigger market for our export in the last couple of years. So it's very important what is going on in the United States for us. So we are observing the situation, and we are seeing that the global economy is slowing down. Not that much in the US, but much more in Europe and also in Asia, and that has a big impact also on Swiss export opportunities. So we see that the Swiss economy is still growing, but the pace of growth is a little bit slower than it used to be. And we have to take that into consideration when we are also considering what kind of monetary conditions are appropriate. Next to the economic situation is, of course, the inflation. The inflation is very low. It's also low in Switzerland, and it's lower than it used to be in the past. So this is something that comes in addition to the slowdown that we are observing at this moment in the global economy. We are a little bit a price taker regarding the global economy. So we have little influence on the global economy, but of course the global economy is impacting us a lot, mainly Europe, but also US and China. These are the three big parts, regional parts, that have a big impact on the Swiss economy.
Could policy uncertainty, for example, the uncertainty related to trade policy and Brexit negotiations, be playing a role in dampening global growth?
So I think they are. I think that is the case. We've been hearing from we have a vast array of contacts within the U.S. economy, as you would imagine, and we talk to them every FOMC cycle, of which there are 8 every year. The reserve banks go out, and we've been hearing quite a bit about uncertainty. So for businesses, particularly to make longer-term investments in plant or equipment or software, they want some certainty that the demand will be there. They want certainty that there'll be growth and that their supply chain is secure. And I think we would never comment on trade policy. We don't do trade. It's not a responsibility of the Fed. But I think it is the case that uncertainty around trade policy is causing some companies to hold back now on investment. And so our obligation is to use our tools to support the economy, and that's what we'll continue to do.
Keyword: recession fears. How worried should we be about an upcoming U.S. recession, given all the talk in the media? Do you see a particular shock that could trigger a recession? Yes, please.
Yeah, so we're not forecasting or expecting a recession. As I mentioned, incoming data for the United States suggests that the most likely outlook for the United States economy is still moderate growth, a strong labor market, and inflation continuing to move back up. I went through the numbers. I'll say a little more about the labor market. Payroll jobs are coming in at well above the level that new people are entering the labor market, and that means that the labor market is still tightening at the margin. By so many measures, the labor market continues to strengthen. So the consumer's in good shape, and really our main expectation is not at all that there'll be a recession. I did mention, though, that there are these risks, and we're monitoring them very carefully, and we're conducting policy in a way that will address them. But no, I wouldn't see a recession as the most likely outcome for the United States or for the world economy, for that matter.
Right. Thomas?
No, our main scenario, our base scenario, is not one of a recession, neither for the global economy nor for the Swiss economy. I have to say that we have in 10 days our monetary policy meeting again, and then we will have a new base scenario, a new forecast. But let me just come back for 1 second to the trade issue. I think this is a very important one, so especially for small open economies. The functioning of global trade is key. So we depend on a functioning global economy where it's possible to trade, import and export. And of course, the uncertainty that is at the moment in the global economy is having a rather negative impact. And we not only maybe the trade, but also the Brexit discussion is creating a lot of uncertainty. So consumers and also investors, producers are unsure whether they should buy, should invest, or do anything. So of course, this creates uncertainty and has a rather negative impact at this point. So from point of view of a small open economy, I think it's a wish to everybody in the world also to contribute to, I think, a reasonable solution to these trade disputes.
Just a little additional question. Let's having a look at Europe, the European Union. Do you still think it's all fine there, or do we have to see some disruptions and problems in different states?
Well, regarding Europe, so we are in the middle of Europe. We are not part of the European Union, but the economic integration is very deep with the European Union. So export and imports are big. So we export a lot, but we also import a lot. And it's of mutual interest to have here sensible economic conditions. And of course, every time the European economy is not growing, that has a big impact on us. So if Germany, France, or both together, and even together with Italy, have a low growth situation or even a recession, this has a big impact on us as well. So we have a big interest in a functioning, well-functioning and growing economy in Europe.
We're all interdependent, absolutely. Now, challenges facing monetary policy. The Federal Reserve, Governor Powell, is conducting a public review of its monetary policy, strategy, tools, and communications practices. What prompted you to conduct such a review?
The challenges that central banks face evolve over time, and sometimes they rise to the level where we need to assess whether our policy framework needs to be updated to deal with different challenges. A good example of that is after the great inflation period of the late 60s and 70s, central banks really didn't do a good job of getting control of inflation, but coming out of that came a new commitment to getting control over inflation, which was successful, and the framework of what's called inflation targeting. And I think we've had a number of decades now of where inflation's been under control, and actually other economic outcomes have been better as well. So I think if we look back now over the last decade, we again see a new macroeconomic landscape which looks like this. It's slower growth, lower inflation, and lower interest rates. And the implication of that is that central banks will be rates will be closer to zero. Central banks will have less ability to support the economy in a downturn should one come. And this, I think, is the main challenge for central banking now. It's the biggest challenge we face. It's lower neutral rates and lower inflation. And we see what's happened in Japan and now to some extent in Europe. So we thought this was a great time to look at our framework and see whether we can find new ways to address that, new tools, new strategies, tools, and communication. So we're also, I would say, an important part of it is we have done a public engagement at a scope that really the Fed has never done before. The Fed's never done this kind of a public review before, so we thought it was an appropriate thing. So we've had these meetings around the country. We call them Fed Listens events, and they're live streamed on the internet. And we're meeting with community groups and labor groups and business groups and all different constituencies, not just academic monetary economists, although we meet with them too, of course. And I would say that the gains from that have been very striking. It's striking for anyone who's been to one of these events. You're really struck by how much people care, how important it is in their lives what we do. So just to wrap up, we're taking all of that, and now we're having a series of meetings at the FOMC, and we're looking carefully at our tools, strategies, and communications, and we'll announce decisions on that sometime next year, but so far we think it's quite a healthy exercise.
Going to the country, so to say, could also be a model for you, Thomas. What do you think about that for Switzerland?
Well, we do not have exactly the same exercise, but we have an ongoing dialogue, I think, with many, many groups in Switzerland regarding monetary policy and also about our monetary policy concept. But what we get as a reaction everywhere is that people like price stability. So this is our mandate, and this is given also in the law of the Swiss National Bank, and nobody really complains about high inflation. So people want to have price stability. And we have, and this is a little bit different than many other central banks, a definition of price stability that is rather a range than a point target. This is important for us because it is rather difficult to steer inflation over the short to medium term exactly in a very precise manner. But in the average or over medium to long term, inflation was very stable in Switzerland, on average around 1% over the last 20, 25 years. So that was, in our view, a very big success. So we have, at this moment, very little reason to change that. Obviously, as Jay mentioned before, the lower bound, the effective lower bound, not to have the possibility to lower rates indefinitely is, of course, an issue. But so far, we could circumvent that with other measures in order to steer monetary conditions in a way to achieve price stability.
Let's talk about the interest rate, a very important topic, controversial too. It has declined substantially over the last 2 decades in many advanced economies. What are the macroeconomic implications of this decline?
Yes, so I think really for the last 20 years, we've seen what we would call the neutral interest rate decline by at least 2 or 3 percentage points, and there are people making arguments that it's actually more than that. So why is that happening? It's a lot of factors. It's the aging of the population, which leads to a higher appetite for safe assets and more savings relative to investment. It's low productivity. It's low growth. It's all of those things. And so you get in a world where the neutral real rate is low, but inflation is also low. And what that means, if you add those two together, you get the interest rate. So the implications are, as I mentioned earlier, that central banks will have less ability to counteract a downturn by cutting rates. Typically, in the United States, since World War II, we've cut more than 5 full percentage points, or as we say, 550 basis points we've cut in a typical downturn. Now our federal funds rate is about 2.1%, so we won't have that ability here. So one implication is that we need other tools, and so when we got to the zero lower bound during the financial crisis, we used quantitative easing and we used forward guidance about the interest rate, and we feel that they worked, although are not perfect substitutes for the interest rate. I mean, I think one essential feature of this, from our standpoint, is not to allow inflation to move materially below target, because if that happens, then that will work its way into interest rates. So we're very committed to defending the 2% inflation target on a symmetric basis. We've seen low inflation become the case moving down, and you get on this. You seem to get on this road that it's hard to get off of, and we're trying not to get on that road and actually defend our 2% inflation target where it is now.
Thomas, your policy on that topic?
Well, I think this is one of the absolutely key questions at this moment, and having this lower neutral rate is a difficulty for pension funds. So all these systems were built on higher interest rates. This is a real phenomenon, not only a monetary phenomenon. So we have these difficulties, and it's very difficult to explain that to the public. So this comes in addition, and of course, the room of maneuver for central banks to react to certain shocks is smaller today than it used to be maybe 20 years ago. And as Jay mentioned, this means that central banks have to find ways in order to have instruments available in case it's necessary to have an impact on monetary conditions. This is much more demanding than it used to be 20 years ago. This is true.
It gets more and more difficult, or challenging, let's say challenging.
Well, the challenge is in a way that we probably, on a global scale, missed to some extent the normalization. So we went all the way down to zero, even negative, with the hope that everything will go back at least to some normality, but that did not happen because of the economic cycle and because inflation did not come back exactly as expected. And now we are a little bit in a new situation where on low level of inflation, already low interest rates, maybe some further instruments are necessary, and this is the big debate that you just started.
Keyword central bank governance. How do you, Governor Powell, coordinate when taking monetary policy decisions?
So in the United States, we're blessed with a fairly large committee. So as many of you will know, at full strength, there are 7 governors on the Federal Open Market Committee. Those are all nominated by the president and confirmed by the Senate, and we serve 14-year terms. We also have 12 reserve banks around the country, and those reserve banks, on a rotating basis, share 5 additional votes. So effectively, but when we have our meetings, everyone has a voice at the table. So what that means is that I talk to every other participant on the FOMC at least once per FOMC cycle, and that's 8 of those a year. I think that this arrangement of reserve banks around the country and also the 7 governors, it guarantees that we will have a diversity of perspectives around the table. The Reserve Bank presidents are chosen by their boards of directors, who are largely private sector people, but with the approval of the board. And I think this system guarantees, again, a diversity of opinions. There's that risk of groupthink if everyone's in the same building and went to the same schools and took the same professors. We don't have that. We have people coming in every 8 weeks with different views, and I have to say, I wouldn't have it any other way. I really do. I spent a lot of years, as I mentioned, in the investment business, and what you really want before you make an investment is to have the smartest person in the room try to explain to you why this is a bad idea. Not after you make the investment, but before. So, and I place huge value on that. So Mike, I have terrific colleagues on the FOMC, and I really do actually welcome all of that. So it's a lot of consulting, but again, I wouldn't have it any other way.
And it's the policy of convincing, right?
Sometimes. So it's to a large extent, it's a policy of putting together a consensus. So my nature is to want to incorporate people's thinking and develop a consensus. Sometimes it's me convincing, sometimes it's me trying to move people into a group. But I think collective decision making can work, and I think in our case it has worked well.
Would you like it to have like this, Thomas, too?
Well, every country has a little bit of different history and different institutions. So we are blessed in Switzerland by a small board, but a very well-functioning board. I'm looking to my colleagues here. And the situation is a little bit different. So we have a lot of discussion also with our economists. So we have this variety of views within the bank in any case. But Switzerland has also a tradition, not only at the Swiss National Bank, but also in the government, both at federal but also at cantonal level, that you have a college, and the college takes together responsibility and also try to find a consensus and tend to defend this view vis-à-vis the public. And that worked over more than 100 years very well at the Swiss National Bank. And it also forces you to find a solution, even in difficult times. And we are a small country exposed to these international shocks. So the governance that we have for our case, for our country, worked very well so far. And it's really to find a consensus and then to defend this view vis-à-vis the public together. And that worked well. And I'm personally convinced that, and I do not speak for other countries, it's really something that is very specific, should not be changed. And it helped Switzerland, not only at the central bank, but also at the government, both at federal and cantonal level, very well.
True, no? Never change a good working system unless you see that you have even better options. But this is also risky.
Could I add? So actually, it's the same in the United States. We had 2 failed central banks. At the very beginning of the Republic, if you ever saw Hamilton, the musical Hamilton, that's the first one. There was another one, and the second one died in 1836. And the difference was they were very much East Coast based, and and the rest of the country was sort of suspicious in those times about having power over money and banking concentrated there. So the beauty of our system is what I mentioned, which is we have reserve banks all around the country, and this turns out to be a much more balanced and sustainable structure. We're 106 years old, I guess, now, and I think this federated structure that we have has served the country well, and it's also rooted in our history, as you say.
Crucial topic. Some have suggested that the Fed consider the impact of its decisions on the outcome of the 2020 presidential elections. Do you consider electoral politics to be a new part of your mandate?
Absolutely not. Political factors play absolutely no role in our process, and my colleagues and I would not tolerate any attempt to include them in our decision-making or our discussions. That's not our DNA. Our DNA is what I mentioned earlier. We're strongly committed to non-political decision-making. We serve all Americans, regardless of their political party, and it's just simply wrong. The idea that we would deviate from that is just simply wrong, and so the answer would be a hard no, let's say.
Like in Switzerland.
Yeah.
We couldn't agree more. Digital currencies. Are central banks missing out on the challenges, but also the opportunities represented by digital currencies?
I don't think so, no. So I think, of course we're following very carefully the whole question of digital currencies. It's not something that we're actively considering, other central banks more than we are. And for us, it raises significant issues that we'd want to see, carefully resolved. For example, if you think about a currency that was for the United States or for, frankly, a multinational currency, it would really need to be cyber secure because, it's one thing to be able to counterfeit paper currency. It's another thing to be able to hack into a cyber currency and create with a computer however much of it you want. So the cyber issues are quite daunting. It's also not clear to us that there's really demand for this. Consumers have plenty of payment options. They're not clamoring for this. I don't want to sound like I'm ruling it out, but I think there really are. There's another question, too, which is if people are leaving their money in a cyber currency and holding it there, they're not putting it in a bank. What happens with banks is people deposit their money and banks lend the money out. So what will happen to intermediation, the whole intermediation process? What will happen if everyone's just, investing in this cyber currency? So I would say, look, we're in favor of financial innovation. We're following these things very carefully, but we don't see digital currencies from a central bank as something happening in the near term.
Thomas, how do you see it?
Well, we looked at that very carefully, and we have a similar view, probably. So we do not believe that it's a very good idea to have a central bank digital currency for the public at large, exactly for the same reason. And we also have a very efficient payment infrastructure in Switzerland, so there's almost no advantage to make a payment with a digital currency, central bank digital currency, for the public at large. What maybe a little bit a different situation. So if we have new financial market infrastructures where banks, among them, trade securities, and you need to also create some new money that comes from central banks that make this system more efficient. So we are looking at that very carefully, but this is not yet sure. So it's not yet sure whether new forms of securities are more efficient than old ones and whether this new infrastructure actually need digital central bank currency. It's well possible that the link to the central bank may be as efficient as today and in this system. But it's a very important and very interesting question, and we're also happy to be part of this BIS Innovation Hub that looks at those issues very carefully, and I think it's very important that central banks are aware of all these innovations and about all the possibilities.
Absolutely, absolutely. What is your take on the Libra, the new Facebook currency with headquarters in Geneva?
So I want to start again by saying that we do want to see responsible financial innovation. We think that's key. We think that will enable people to be better served and drive costs out of the system. So it's important that we be open to that. I think, as I've said before about Libra, with Facebook's very large network of more than a couple billion people, a stable coin could be systemically important very quickly if it were to have wide adoption, and that's not a foregone conclusion. But because of that, we would think that Libra would need to be held to the highest standards. It could be systemically important right away, potentially, and because of that, it would have to be held to the highest regulatory and supervisory expectations. It is not obvious to see how that would happen under our current regulatory system. So it's the kind of thing where we've said this is not going to be a sprint to implementation. This is going to be a careful, thoughtful conversation about how we can do our job of protecting the public from cyber risk and all the other risks that come with something that's systemically important.
So if I take your answers all in all, you're quite optimistic. Is that true?
Well, about things in general, yes. Yeah. But I would say
about Libra,
you always want to be an optimist. But I would say Libra has a burden of proof to carry. Again, we don't want to just be an obstacle about this. But I think it's appropriate for us to say what we think our expectations will be, and appropriately so, they'll be very, very high for something that could have such broad adoption. And they'll have to be met. And so that's the way to think about Libra, I believe.
Yeah. Murphy was also an optimist, as we know. Okay. Thank you very much. I think we should open the discussion to a few questions. And I see some ladies and gentlemen who would like to ask one behind there. Far behind the second row.
Hello, Mr. Powell. Welcome to Switzerland. I would like to know what you think, because the market is widely expecting some accommodation. Do you feel like meeting that accommodation will be enough to support the economy, or do you feel like you might need to do more to provide that accommodation?
Just answer directly.
Please.
So I'm just going to go back to what I said earlier, which is that we're watching all of these developments. You know, the geopolitical risks. We mentioned Brexit. There are others. The events in Hong Kong. Watching those carefully. Watching incoming data, and really looking at financial conditions broadly. And we're going to be assessing those as we go into our next meeting and future meetings. And what we've said is that we're going to act as appropriate to sustain the expansion. And I don't have anything other than that to say here tonight.
Please.
Can you wait for the microphone? Mr. Powell, you spoke about the diversity of views on the FOMC, and we have seen in the past couple of weeks exactly what that diversity of views means. We've had Eric Rosenkranz at the Boston Fed saying he doesn't see a need for further accommodation, yet we've seen James Bullard from the St. Louis Fed looking for an immediate 50 basis point cut in rates. How do you square that circle? How do you consider these diametrically opposed views?
Well, you know, so I think sometimes it's easy to get unanimity on things when the path is clear. There'll always be questions about, you know, how much to do and how fast to move and things like that, but sometimes things are relatively clear. Other times it's murky out there. And you don't really, you know, there's a range of views, and I think this is one of those times. Trade policy uncertainty is not something that central banks have a lot of practice in dealing with. So as I mentioned in other occasions, you know, we're trying to look through short-run developments and try to assess what the implications for the outlook in the medium and longer term will be of those developments. So it's challenging, and we are clearly at a time where there's a range of views. And again, I do think that's a very healthy thing. We will, of course, reach a decision. I expect we'll have a strong support for the decisions that we made, as we had in July. I expect that'll continue. But this process of having disparate views, I think, is not something that I feel concerned about. In fact, I think it's appropriate given the situation we're in right now.
Professor Straub.
Thank you very much for coming. I have a question for both of you. Kind of a delicate question, I'm sorry, but that's why we're here. What's the relationship with the Chinese central bank in these days? I mean, we have these political tensions, but you're technocrats and you're trying to exclude political tensions, but still, how is the relationship with China? And how independent is the Chinese central bank really? Is it enough to just talk to the central bank governor, or are you talking to the finance ministry all the time, or to other people? It's very hard from the West to imagine how this cooperation is really working.
Well, so remember, we're not part of the government, so we don't talk about trade. Trade is not an issue for us. So the Chinese central bank attends these international forums, and we have discussions about the global economy, but we're not in the room. We, as the Fed, are not in the room on trade discussions. We're not an advisor to the government in any way. That is not the case for the Chinese central bank. They are part of that conversation in China. So we don't see that part of the world. But I mean, part of the reason of having these international forums is that even when there are difficulties, there are places where we can sit down and hear what's happening in each other's economies. But again, we don't cross the line into what governments. There are issues that are consigned to elected governments, and we don't comment on those. We don't take part in those. We stick to the things we're responsible for, which are stable prices, maximum employment. So that's how I think about it.
No, I fully agree, but let me just add one thing. I think all central banks among each other have relatively good relationships, and we have very good relationship to the Fed, but of course also to the Chinese central bank. And this is very important. When we meet in Basel, we have to get a really good view about the global economy. This is maybe the most important element of monetary cooperation. So you do never take the same decisions or coordinate decisions, but knowing exactly what is the economic situation in China or the US helps everybody else to understand the situation, and this is much better. It limits spillovers and spillbacks, so we have this relatively open exchange of views so that we have a good grip on the situation in Asia, in America, in Europe. So this is a very open dialogue, and I think this is something that developed extremely well during the last couple of years. And this is exactly because we are not part of the government. So we are technocrats, and we can have this open issue or this open dialogue there.
Governor Powell, you mentioned that you've been working on a new monetary framework in the United States, and I was wondering whether there is also an international dimension. You've been thinking also about an international monetary framework. I mean, are you happy with the way that the international monetary system has been working? Are there any thoughts about contributing to something new? Does Thomas have any ideas on the international monetary side? So this is the first question. And the second question concerns the Phillips curve. From your comments, you said things are very good in labor markets, wages are going up, and we're just hoping that inflation is going to go up. Is this just wishful thinking about seeing the return of the Phillips curve, or is there some deeper reason that?
Sorry, so the first question was, our review is not about, returning to a different international monetary framework or even, having a global currency or anything like that. It's really about our domestic tools in our domestic context. So, for example, we're looking at strategies where there would be a makeup for inflation below target. This is an idea that's been around for a couple of decades. The idea is that if inflation is meaningfully below target for a sustained period, then the central bank would communicate so that people understand that there will be a makeup period, meaning a boom of inflation above target. And if the public understands and acts upon that, it'll actually limit the damage from the recession. And it's a great idea. The reason no central bank has really done it is it's hard to find a way to implement it practically. So we're looking really carefully at those ideas. That's a classic idea that we need some of those ideas to work at the zero lower bound. I'll talk about the Phillips curve briefly. So there 50 years ago, there was a close relationship between the level of slack, for example, the level of unemployment in the economy, and the level of inflation. That has gone away, really. It's still there, but it's a faint heartbeat. It's not what it was, and there are a number of possible candidate reasons for that. One of them just is that central banks and have kept inflation under control so well for so long now, really particularly the last 25 years, that inflation expectations are well and truly anchored, and therefore inflation doesn't go down much when the economy's weak, and it doesn't go up much when the economy's tight. And I think that's really where it is. There's always a question of, is there a steep portion of the Phillips curve? Have we, for example, is the problem not the slope of the Phillips curve, but that we've got the wrong estimate of the natural rate of unemployment? For example, maybe the labor market's not as tight as we think, and it'll get tighter, and suddenly we'll hit this steep Phillips curve. Haven't seen any evidence of it. I don't think we know the answers to these questions. I think that's why I think we have to use a huge dose of common sense and risk management in our policies. In terms of the international monetary system, I would say I think that the system of floating rates, along with a commitment from central banks not to target their domestic economies and not the exchange rate itself as such, is working broadly. I don't know, Thomas, I'll stop there.
No, well, I'm not sure, but probably you are alluding to the fact that we have also a dollar dominance in the international monetary system. And there is sometimes a discussion about that, but this is the result, I think, of the economic dominance of the United States and in financial markets. And in fact, you can only change that if other regions gain in economic importance. Otherwise, you cannot order that. This is something that has to evolve. And it's a fact that we have also a banking system globally where dollar funding remains one of the dominant funding sources. And as long as this is the case, the dollar will be by far the most dominant currency. And this even increased during the last couple of years during the financial crisis. And this will only change once the economic importance of Europe will become bigger again. And then the other currencies may also gain importance. But otherwise, I think it's very, very difficult. This brings me to a point that for emergency situation, the liquidity distributions among central banks is something that is absolutely key. So the swap agreements that exist between all major central banks is really one major element of this safety net of the international monetary system.
Over there. We have to cut soon, but maybe 2 or 3 questions. If you put short questions, you also get slightly shorter answers, okay?
Governor Powell, if I understood you right, you are very happy that the inflation in the US is around 2%, and it was somehow a target. I also learned that Japan was trying to get inflation up to a certain degree, unsuccessfully. On the other hand, I hear from the National Bank that price stability is prime. But somehow I have the feeling Europe is not very successful to get inflation up to a certain point, and many other countries maybe are looking also at that. Would you have a recommendation how to get the inflation to this 2%, which would be healthy for balance sheets, for the future, for credit, for lending?
A recommendation for Europe? No, I wouldn't presume to make. I will just say that we have inflation which is just below 2%, and it seems to be bouncing around between 1.5% and 2%. And you would think 11 or 10.5 years into an expansion with historically low unemployment and strong growth, you would think that inflation would have been more kind of symmetrically around 2%. It's not the case. So our strategy is to avoid this problem of having inflation expectations slip down, because once you're on that road, it seems to be hard to get off it. But I wouldn't presume to offer any advice to Thomas or to our ECB colleagues.
Maybe somebody from the students group? Nobody daring to do that? Here. You, please, with the black shirt.
Oh, you got one there, though, too.
Mr. Jordan, why don't you give every Swiss citizen 500 Swiss francs in new printed 100 Swiss bills, because that would help the consumption and it would lower the Swiss franc?
It's a very good idea. And if we could, we would do it immediately. But it's against the Constitution, against the law. This is not foreseen that we give gifts to the population. This is not something that makes sense. And also to say that in the situation that we are at the moment, ideas like helicopter money, etc., doesn't make really any sense. So we are in a situation where unemployment rate is 2.3%. The growth is something between 1% and 2% on average over the last couple of years. So this is relatively a good situation. So when we give you 500 Swiss francs, then somebody else comes, we would like 1,000 Swiss francs. We have a good project for this or that, etc. And at the end, these are not decisions that should be taken by a central bank. This is something that is really political and has to be in the parliament or by the government taken and not by a technocratic central bank. So giving away money for free, giving it as a gift, this is really a political decision and not a decision that should be taken by a central bank.
Okay, here's the last question. No, sorry, we give it to the lady. Excuse me. Ladies first. Sorry, next time.
Thank you very much. Good evening, Mr. Powell. I'd like to ask a follow-up about the LIBOR project and the Fed's working group that's tracking the project. When you mentioned the burden of proof that falls on the project, can you speak at all to how the association has been meeting this burden of proof? What further input you've received in recent months? And how you feel it should fall within the regulatory scheme? And finally, speaking to your coordination efforts with other central banks,